Whenever we talk about level funded health plans, first it's important to talk about why do they exist, right? Why do they exist in the first part? And why have they become the fastest growing type of health plan in America in that, let's call it that 10 to 200 employee space? Well, we all know what's going on with health insurance renewals, not only the individual marketplace, but group insurance plans in the market today. I haven't seen messaging from the carriers like this since the 90s, and I've been in this business since 1987. And this is the worst renewal season that I have seen since the mid 90s. So if you look down at that lower left, right, you ask yourself, where else in the economic universe do you get to say with a straight face, hey, the bad news is your vendor was going to increase your pricing 14 or 15%. The good news is I got it down to 6, 7, 8%. Like nowhere else in the economic universe is telling somebody year over year over year that getting a quote unquote single digit less than 10% increase is good news, except in the health insurance industry. Like that's how crazy our industry is. And it has been ever since I've gotten into it in 1987. Back then, we were using these same discussions. Hey, trend is 13, 14%. Good news is I got you down to a 6 or a 7 or an 8% increase. But the single rates back then were $80 and a family rate was $250. Today, of course, single rates are 800 or more, and family rates are well north of 2,000, 2,500. But yet we still have this same hyperinflation that has plagued health insurance for all of these decades. So that's the why. The traditional fully insured health insurance system is broken from a cost containment, cost management perspective. And so inevitably, mid-sized employers looked at what large employers were doing, and that was self-insurance, right? It was always the domain of the Fortune 100, the Fortune 200. But in my career, self-insurance came down where you were doing it with groups the size of, 1,000, 2,000 employees. Then it came down into the groups that were 300, 400, 500, 600, 700 employees. Now it is well below 200 lives. And if you look at that footer at the bottom of that slide, McKinsey, the large consulting company, did a study last October, so only a year ago, and in it indicated that over 53% of employers under 200 employees are self-insured today. Surprising number. You know that the large employers are, but now more than half of employers under 200 lives are self-insured, and you'll see that it's just going to grow exponentially over the next 7 to 8 years. So the why: hyperinflation in traditional health insurance. Anytime that happens, you have to look for an alternative way to buy what you're buying. And so self-insurance has come down market. That's the why. But when we talk about level funded health plans, we still have to understand what are traditional self-insurance plans. And I'm going to get into more of these details in a little bit. But fundamentally, think of traditional self-insurance, or cost plus, as I call it, where you're going to pay as an employer a low fixed cost every month, and then you have to fund your claims as the claims administrator tells you, hey, I need $15,000 in the bank account this month or this week. Next week, I need 30,000. The week after that, I need 5,000. The week after that, I need 17,000. So that cash flow bouncing up and down, not so problematic for a larger employer with a strong cash flow balance sheet and a lot of people in their financial office to handle it. But that can be a challenge for smaller employers, that bouncing around. So thus the creation of level funded health plans. And so the key to level funded health plans is think of them as administratively, they look and feel like a traditional fully insured plan, where the employer, we move away from age banded fully insured rates, and there's composite single employee and spouse, employee and children, family rates. So the employer just pays the monthly billable rates each month. That's it. Looks and feels to them like a traditional insured plan from that perspective. But these are self-insured plans. And so as you see there in the blue, the real advantage of going into self-insurance is you get to participate in your good claim experience. But with level funded plans, you don't have that variability that I mentioned. Your maximum funding, your plan, at least you should be, and I'll get into this later, but in our plan and others that are run the right way, you're paying the full expense, administration and claims exposure in those monthly rates every month. And at the end of the year, there's an accounting that gets done, and we'll get into that. But at the end of the year, there's an accounting that gets done. And if there's money left over, then the plan sponsor gets that money back. Some players, as you all know, give only 50% of the unspent claim dollars back, and they only do so if the client renews. Others, plug for our company, I said this is not going to be a sales pitch for Premier Health, but just our plan, we give 100% of any unspent claim dollars back. And we even give it back if they leave. They don't have to renew to get their own money back. So that's the summation of an overview of level funded plans. Why? Because of the hyperinflation in fully insured plans over many of these decades, self-insurance has come down market. From an administrative cash flow perspective, sometimes traditional cost plus plans can be problematic for a smaller to mid-sized employer. So thus the industry created these level funded plans that gives the look and feel of a traditional fully insured plan, but you get the opportunity to participate in good claims experience. And you're not exposed to an additional dump in if you max fund the plan. And again, I'll get into some of those details as well. So when you think of a premium dollar, fully insured premium dollar, it is simply putting together all of the costs that it takes to run a health insurance plan. So your fixed costs, you've got administration to pay claims, to do all the billing and eligibility management, to provide access to a PPO network. You contract with a pharmacy benefit manager to manage the claims of the pharmacy side of the business, right? You've got broker commission. You might have an enrollment platform. So all of the fixed costs that it takes to administer, and I'm not even talking about any insurance yet, just to administer the plan, right? That goes into the rates. So think of a PEPM, if you will, for each of those services, and you start building your rate. When you are self-insured, whether it be level funded or traditional cost plus self-insurance, you're never really truly self-insured. Sure, maybe, Google and Amazon and people with billions of dollars and of cash on hand can be truly self-insured. But when we talk about it in our context, self-insurance has a kind of a scary, intimidating kind of feel to it, but you have to dispel that. Think of it as partially self-insured. That's how I've always sold it. Think of it as partially self-insured, in that the employer is liable up to a point inside of the plan for claim exposure, but they have a cap. They have a maximum exposure. So how does that work? So in traditional self-insured plans, a self-insured employer would buy two forms of stop-loss insurance. One is called specific stop-loss insurance. The other is called aggregate stop-loss insurance. Think of the aggregate stop-loss insurance as the umbrella over the whole plan. All claims into the bucket up to a certain point. If the claims exceed that aggregate, that maximum level, then that employer is no longer being asked to fund the claims. The reinsurance carrier, also called stop-loss insurance, is on the hook if the claims go over that aggregate level. That's the aggregate. But then underneath that, in a traditional cost plus traditional self-insured plan, you have specific stop-loss insurance. What is that? That is any claims on any one individual go into an individual bucket. It might be I had COVID, and then I injured my back, and then I had some appendicitis, and then I had a knee injury. All claims into the bucket against Jim O'Connor for that year. And then if it goes up to a specific dollar amount, let's say $25,000 of Jim O'Connor claims into the Jim O'Connor bucket for the plan year, on the $25,001st dollar, the employer is no longer being asked to fund claims against Jim O'Connor. Over the $25,000 mark on a specific stop-loss point in this example, the reinsurance carrier, the stop-loss carrier, now has the liability. So think about it. As a self-insured employer, this is why I use the term partial self-insurance, because the employer in a traditional self-insured plan is getting specific stop-loss insurance, and they pay a premium for that. So the premium goes into the fixed cost, and then the specific stop-loss protects the plan against any one individual having a catastrophic claim that eats up all of the claims. And they buy aggregate stop-loss insurance. That's the umbrella over the top. And again, you're paying, as a plan sponsor, there's a premium, a PEPM premium that goes into the rate for that type of insurance that you're buying. So in a traditional self-insured plan, you buy two types of stop loss insurance, reinsurance. You'll hear those terms used interchangeably. Reinsurance carrier, stop loss carrier, reinsurance, stop loss, interchangeable terms in the health insurance world. In level funded plans, some use both specific stop loss and aggregate stop loss. Others, like mine, do aggregate only. Why? Because these level funded plans are typically for smaller employers, say under 100 employees, under 75 employees typically. And the cost, the premium to charge such a low specific stop loss point in that type of plan doesn't make economic sense in our opinion and the opinions of other underwriters and actuaries. There's a healthy debate on this, but in our opinion, you can go aggregate only in your level funded plan, because what really matters in a level funded plan is what are those monthly rates that the employer is paying each month, and then how much of that is allocated against fixed cost versus claim exposure. Because remember, at the end of the year, there's an accounting that'll get done. And I'm going to talk about how different programs will do different allocations, and it makes it easier or harder for an employer in a level funded plan to get any money back. So we'll put a placeholder on that and come back. So then as you go down, you'll see current plan year expected claims, current plan year margin, runout claims, IBNR, incurred but not reported, mature, max pricing versus immature. So what does all that mean in there? What does all that words? So when you are an underwriter and you're constructing that aggregate stop loss number, the max claim, what you're simply doing is taking the census and demographics and all the factors of that population you're covering, and the computer is spitting out a projected claim number. Here's what I expect this group that looks like this to have in claims over the next 12 months. Expected claims. But think of it like a bank. There's always margin that's going to be over the top of what you expect to happen, right? So there's this margin that gets added to the expected claims. It's typically 25%. Sometimes it might be 15, but the standard is 25% in the small to mid-sized market. So you take expected claims, you increase it by 25% for the reinsurance carrier margin for error, and then that total becomes the aggregate stop loss. So if I did the math and I said the aggregate stop loss is 100, or the expected claims are $100,000, I threw 25% on top of that, the aggregate would be $125,000 of claim exposure. But that's soft dollar, right? That's just the exposure, right? So that's the aggregate stop loss. So you have expected claims, add margin, that gets you your aggregate. And that would be kind of the plan year margin, expected versus aggregate. But then what if somebody leaves, right? Like if you leave a fully insured plan today, we all know what happens. You leave, plan terminates. Any claims that were incurred prior to the plan termination date are the responsibility of that former fully insured carrier paying the claims because you've already pre-funded it. Well, in mature, fully funded max level funded plans like ours, same thing. If the plan ends, you've already pre-funded the runout liability, and so you just move on. Be careful, because there are some level funded plans that are not max funded. So you have to ask, is this plan max funded? What's the runout liability if the client leaves? What's the IBNR? What's the tail? What's the terminal liability? These are all the kind of terms you'll hear. Because in a traditional self-insured plan, unless you address for the runout being protected, those claims that are incurred prior to termination date but submitted for payment to the claims administrator later, they're the liability of the self-insured plan. Unless they've been financially accounted for, they're the plan sponsor's liability. So we'll get into those terms on the right in a minute, but just pause and think about this. Fully insured, automatically pre-funded runout claims. Mature, fully funded, max funded, level funded plans, also fully funding the runout claims. But don't presume so. Get clarity from the level funded producer when you're doing that. And then sometimes you'll hear it's immature with what they call terminal liability option, TLO. That's where you can elect prior to the start of the plan year whether you, the plan sponsor, want to increase the cost of your insurance prior to renewal in order to account for, and again, terminal liability option is the way of saying, if we cancel terminal liability, run out claims after I've terminated, would be already paid for. Some employers say, I'm not going to bother. I'd rather keep my current plan year monthly run rate lower. And then why would they do that? Well, what do these terms mean on the other side? To the right, paid contract, and then all those numbers. This is how one defines your stop loss contracts, both your aggregate and your specific. A paid contract simply means if so plan year, let's use January 1st to December 31st. If a claim gets paid in that plan year, regardless of when it was incurred, remember, incurred is when the date of service is rendered, paid is when the claim is actually paid to the provider. So a paid contract is the most generous contract you can have in that it will pay anything paid in that period of time, regardless of when it was incurred. So if I'm coming out of a self-insured plan and I don't have any terminal liability protection, but I go into a paid contract, well, all that run out from the prior plan year becomes run into my new contract, my new stop loss contract, right? Think of the English language, paid in that period of time. What's a 1212? Okay, the number in front of the slash is always the look back period of when are the claims incurred. And then the second number is what period of time are the claims paid. So if I do a 1212, it means incurred in this 12-month plan year, but also paid within this 12-month plan year. So that's the most immature contract you could get because there's nothing coming in and then there's nothing going out the back side of the plan year. Think of the walls as January 1st to December 31st. So incurred in that plan year, paid in that plan year. Then now you follow the logic. 1218, incurred in the 12-month plan year, but paid within an 18-month period. So the 12 months plus 6 months run out. Paid within, so incurred in the 12, right? Come December 31st, you shut down the door, no more incurral dates taken in. But all that stuff that is incurred but not yet submitted for payment, you've got 6 additional months for those to get submitted in order for those claims, those run out claims to be paid, right? So you would pay more for that contract, of course, than you would for a 1212. 1224, you follow the rhythm. Incurred in 12, but paid not only within that 12-month plan year, but 12 months trailing. 1812, 2412, flip the equation. I'm taking 6 months worth of run-in claims. So say from July 1st of this current year, and then into my new plan year of January 1st to December 31st of 26. So 6 months coming in, that's the 18-month totality of incurral date, and then paid within the 12. 2412, again, you're following the rhythm of the numbers. So that defines stop loss contracts. So for level funding, you really want to know, you don't really care about the run-in because they're typically coming out of either another level funded plan, or I shouldn't say you shouldn't care, but rarely do you worry about it. But you really want to worry about the run out. What happens if the plan terminates? And you want to know what your liability, the plan sponsor's liability is on the back end. Bundled versus unbundled is simply saying, hey, if I buy a level funded plan or self-insured plan from one of the carriers and they're doing all of the administration, providing the stop loss, doing the PBM, providing the network, I buy a level funded plan from Aetna or I buy a self-insured plan from United, that's bundled. It's everything from one place. Unbundled is when you can go into the self-insured world and you can do RFPs and shop for different TPA, for different PPO network. You can shop all the different reinsurance carriers. You can shop the different PBMs. That's unbundled, where as a consultant, you are basically pulling together what you think are the best in class from a service level and pricing level perspective, putting them together, and that's unbundled. That's what I do for a living. But these level funded plans that we do in the small market, small mid-sized market, we're not shopping each component for every plan sponsor every year. We've created turnkey programs. So think of us, think of Angle Health, think of some of the other TPA-based programs. We've already pre-established who the vendors are. But if I'm working with a 500, 600, 700, 1,000 life group, we can then maybe shop the market. They want a little bit more customization in terms of the larger account approach. So what are the employer opportunities and risks when you are self-insured? Whether it be Traditional self-insurance has more flexibility, but also more risk and level funding. So what are the opportunities? So plan design. When you're going traditional self-insurance, you can typically have greater flexibility in designing your plan. And the other thing is, since these are governed at the federal level under ERISA, self-insured plans are not required to comply with the various individual state benefit mandates. You might have a state that requires hair transplant, which I know some do. Some might have unlimited chiropractic, because the chiropractic lobby in that state was very successful at getting that passed into the state legislature, or whatever the state benefit mandate is. So if you have a multi-state fully insured plan, each of those plans will be different in those kind of internal workings. The copays will be the same, the deductibles, all the big stuff will look and feel the same, but you'll have different benefit requirements within each different state in fully insured world. Self-insured world, you don't have to do that. You can say one plan across all 50 states, no deviation. That's flexibility in plan design. Cash flow, we've talked about this. If I'm self-insured, I get that cash flow month in and month out, week in and week out, if I'm on a true cost plus basis. And if I'm large enough, and I like that, I've got a good financial office, I got a good balance sheet, that's cool with me. But level funding, I don't really want that variability. But at the end of the year, there's going to be this accounting that gets done, and I'll get money back. So let's talk about that accounting. So the best and right way to do it, and again, I'm not just plugging us, I know other people do it this way too, is we're going to give the client monthly claim reports, even if they're 10, 15 employees, monthly claim reports so they can track how they're running. And then at the end of the year, it's just simply money in and then money out. If we took less money in than we paid out, anything left over goes back to that employer plan sponsor. There's no mystery to it. It's just you'll see it, you'll track it as the year is going on when you're with a program that gives you monthly claim reports, and then it's just pure accounting at the end of the year. Here's my one knock against the carriers, how they do it. Well, there's two knocks against the carrier programs. I get it. They're the name brand. They've got the network advantage. Those are all selling points for them. But here are the disadvantages. Number one, they do a kind of a secret medical loss ratio calculation at the end of the year. And so you really are not sure what's in that formula to give you typically what's 50 cents of your claims back if you had any money left over after their secret calculation. And you only get it back if you renew. Here's the other problem. Remember I talked about that aggregate claim factor and then your fixed costs? In real plans that like mine and others that are on the TPA side of the business, you're typically going to see that claim exposure upwards of around anywhere from a 65 to a 72, 73% of that total monthly rate. So if I see a $100 rate, just to obviously make it up, it's too low, but see a $1,000 rate, right? So about 700 of that should be attributable to the claims piece of that. And the other $30 or $300 rather should be for all the fixed costs in that rate. That's how it really should, that's how it should be. What the carriers do is they flip it, is they make the fixed cost about 60 to 70%. I won't say 70, but really 60 to 65% of that monthly billable rate. And then only about 35 to 40% are attributable to claims in their model. It's BS, to use a technical term, because obviously the claims expectation is more than that, but they own the whole environment. They own the whole ecosystem. They can do whatever they want with this thing. Well, what's the adverse consequence of that? It's very less likely, I won't say unlikely, but it is less likely that your client's going to get money back at the end of the year because there's been such an artificially lower set claims hurdle to get over, right? If I got a $1,000 rate, a $1,000 expectation, let's use real numbers. Let's say I've got $100,000 of claim expectation that I calculate, but a United or a Cigna or an Aetna are saying it's really only $50,000 or $60,000 because they're flipping. They're just, it's a casino, that never loses. And so they're flipping their formula around to then make sure that they never lose. And so if someone ran that incredibly well, think about it. They ran that incredibly low from a claims perspective, and yet they're only getting 50 cents of their money back. I'm not sure if I really like that equation. But again, they hold you hostage because they've got that name brand network, the name brand carrier name. Again, those names are not as solid these days, but they certainly are still there. And then on the right side, we talked about the cash flow, balance sheet. The risks are ongoing large claims, right? If you're always going over, you've got, hemophiliacs and ongoing large claims, maybe you should stay in the fully insured world. Regulatory and reporting, you've got to do 5,500, you've got to do the PCORI fee, you've got some additional regulatory and reporting requirements. The other thing is fiduciary liability, which people tend to gloss over. When you're in a self-insured plan, if there's a claim dispute and there's a claim filed by an employee that says, I'm suing the insurance company in my fully insured plan for non-payment of my claim, then in a fully insured plan, the Blue Cross is the opposing party. Aetna is the opposing party in fully insured plans. In a self-insured plan, the employer at the end of the day is that counterparty to a claim dispute between their employee or their employee family member and the plan, air quotes, the plan. In self-insurance, at the end of the day, the employer is the ultimate fiduciary in a self-insured plan about all the administration, payments, responsibility of the plan. And so if it goes all the way to the court of law to fight about a claim being paid, the other person across the chair in a fully insured plan is the insurance carrier. In a self-insured plan, it's the employer. And don't let any carrier rep or anybody tell you, no, that's us. We do that. You cannot transfer your ERISA-based employer liability in a self-insured plan to any other party. It's ultimately you, the plan sponsor. That's who the ultimate liability lies with in self-insurance. Fully insured, it's the carrier. Self-insurance, it's the employer. And then the last point there is to captive or not to captive, right? Captives I see as beneficial in two environments. And there's, again, this is an area where we get a whole on great thoughtful discussion around the benefits and challenges of a captive. If you have a small number or medium number of large employers, I'm working on a homogeneous industry group right now in one state. Together, there's about 8 of them. They have about 13,000 employees together. They can come together, create their own captive. They own it. They can buy in bulk and power with them as one enterprise, and they can own it. So not only do they get their claims back if it runs well, but they can get profit sharing out of the stop loss exposure, out of the claims liability. So captives can be really, really strong for a large single employer, a group of employers that want to come together. It doesn't need to be homogeneous industry, but it could just be like-minded employers. Or I go the other way, to the very small end of the scale, maybe under 20, under 30, under 50 employees, where again, the captive is buying stop loss premium and admin fees and PBM access fees and prescription formularies for tens of thousands of people, and that can be opportunistic. But you got to be very, very careful about exposure if the captive goes bust. Who owns it? Who owns the rental liability, et cetera? The mid-size employers, 100, 200, 300, 400, 500 employees, I think they're kind of tweeners, right? They could be better off in a captive, but oftentimes they'd be better off on their own because they're large enough to be on their own, don't need the protection of the captive with a bunch of small employers. So captives are interesting. And also there's a lot of them out there. It's the buzz term of the day, but be careful. I use one. I use one for our microgroup stuff, 1 to 9 employees. I think it's a tremendous captive, right? But then I've also seen others not so good. So that's kind of the whole discussion for this. I appreciate everybody spending time with me today, and enjoy the rest of your day, and good luck selling here in the fourth quarter.